Hi, welcome back. Today we're looking at something strange happening in the silver market, and once you see it, you won't be able to unsee it. On the screen, or in the headlines, silver's paper price has been sliding. Futures charts show red candles. Some analysts are calling it a correction, and casual observers might assume the metal is simply losing demand. But if you look away from the price chart and instead look at what's happening on the ground, in refineries, in vaults, at dealer counters across the country, you find something completely different. Premiums are climbing. Wait times for physical bars and coins are stretching out. Some dealers are quietly rationing what they sell. That gap between what the paper market says silver is worth and what people are actually willing to pay to hold the real thing in their hands is the story we're unpacking today. And there's one metric in particular that tends to show this divergence more clearly than almost anything else, so stick with me, because by the end of this you'll know exactly what to watch. Let's start with why this matters right now, in 2026. Silver isn't just a shiny metal people put in jewelry or old family coin collections. It's become one of the most industrially demanded materials on the planet. Solar panel manufacturing eats through enormous quantities of it every year, because silver is simply the best conductor of electricity we have at scale, and every new solar farm being built adds another layer of demand on top of what already existed. Electric vehicles use it in wiring and sensors, and as more automakers shift their production lines toward electric models, that demand only compounds. Semiconductor production, the backbone of everything from smartphones to data centers running artificial intelligence workloads, depends on silver's conductivity properties too. And the build-out of AI infrastructure over the past couple of years has quietly added another steady source of industrial consumption that didn't exist at this scale a decade ago. So you have industrial demand that keeps climbing year after year, layered on top of traditional investment demand, at the exact same time that mine supply has struggled to keep pace. Most silver, by the way, isn't even mined on its own. It comes as a byproduct of mining for other metals like copper, zinc, and lead. That means silver producers can't simply dig more when prices rise, the way you might expect in a normal supply and demand story. A copper mining company isn't going to change its entire operation just because silver prices tick higher, since silver is a secondary output for them, not the main product they're chasing. Production is largely locked to decisions made in completely different industries. Now this is important because when supply is structurally constrained like that, and demand keeps climbing from multiple directions at once, you'd expect the price to reflect that tightness. And for a while it did. But recently, something has pulled the paper price down, even as the underlying tightness seems to be getting worse, not better. So let's break this down and talk about what paper silver actually means, because this is where a lot of confusion starts. When you see a silver price quoted on a financial news site, that number is almost always coming from the futures market, primarily COMEX, which is the main exchange in the United States where contracts for silver delivery are bought and sold. Well, here's what this means in practical terms. The vast majority of contracts traded on COMEX are never actually settled with real metal changing hands. Traders are buying and selling promises, essentially paper claims on silver, and most of those contracts get closed out, rolled over, or cash settled long before anyone shows up asking for a physical bar. This system works fine most of the time, because it allows producers, jewelers, and industrial users to hedge their price risk without needing to physically move metal around constantly. But it also means that the price you see quoted can, in theory, be influenced by an enormous volume of trading activity that has very little to do with how much actual silver exists or how many people want to hold it in their hands. Now compare that to the physical market. This is the world of coin dealers, bullion shops, refiners, and everyday people walking in to buy an ounce of silver to hold at home. In this market, price isn't just about a futures contract ticking up or down on a screen. It's about actual scarcity. If a dealer has fewer bars on the shelf than customers want to buy, they raise their premium. That's the amount charged above the quoted spot price to slow down demand and protect their remaining inventory. Think about it this way. Imagine a grocery store during a supply shortage. The listed price on the shelf tag might not move much, but if people are lining up and stock keeps running out, the store finds other ways to manage that imbalance, maybe limiting how many units each customer can buy, maybe raising prices on what's left. That's essentially what's happening with physical silver premiums right now. Even as the headline spot price has dipped, Premiums, the real-world cost of getting your hands on actual metal, have been climbing in a lot of retail channels. That's the divergence. Paper price down, physical cost up. Two markets, same metal, telling two very different stories. And the interesting part is that this gap doesn't show up in the headline number at all. You have to actually go looking for it, checking dealer websites, comparing premiums across different sellers, or talking to people who work in the bullion business day to day. This brings us to the one metric worth watching closely, and it's something you can actually track yourself without needing any special access. It's the relationship between COMEX registered silver inventories and the volume of contracts that could theoretically demand delivery. Registered inventory refers to silver sitting in COMEX-approved vaults that has been specifically earmarked as available for delivery against futures contracts. There's also a separate category called eligible inventory, which meets the exchange's quality standards but hasn't been formally committed for delivery. When registered inventories shrink relative to the number of open contracts that could ask for physical delivery, you get a coverage ratio that tightens. In simple terms, more paper promises are chasing a smaller pool of metal actually sitting there ready to be handed over. Historically, this ratio has stayed fairly comfortable, meaning there was always plenty of metal relative to delivery demands. But over recent months, that cushion has been getting thinner. It doesn't mean a dramatic event is guaranteed tomorrow, but it does mean the room for error, the buffer that keeps the system running smoothly, has been shrinking. Now let's think about why this divergence might be happening in the first place, because understanding the why helps you make sense of the what. Part of it comes down to how futures markets can be influenced by large volume trading that isn't necessarily tied to physical demand at all. Big financial institutions, algorithmic trading systems, and short-term speculators move enormous sums of money in and out of silver futures based on interest rate expectations, currency movements, or broader market sentiment, sometimes with very little connection to what's happening at the mine or the refinery. When there's a wave of selling in the futures market, whether it's driven by profit-taking, hedging strategies, or a shift in expectations around the Federal Reserve's interest rate path, the paper price can fall quickly. Meanwhile, on the physical side, the people buying coins and bars tend to be reacting to a different set of signals entirely, things like economic uncertainty, currency concerns, or simply the desire to hold a tangible asset outside the traditional financial system. Those two groups of buyers and sellers aren't always moving in sync, and when they diverge sharply, you get exactly the kind of gap we're discussing today. If you're finding this breakdown useful, consider tapping that subscribe button, so future videos like this one land right in your feed. And a quick like helps this channel keep bringing these kinds of deep dives to more people who are trying to understand what's really moving these markets. Now let's keep going, because there's more to this story. It's worth pausing here to acknowledge the other side of this conversation, because a responsible look at any market divergence has to consider the skeptical view too. Some analysts argue that premium spikes in physical markets are often temporary and localized, driven by short-term dealer restocking cycles rather than any deep structural shortage. They point out that premiums have widened and narrowed many times over the years without leading to any dramatic price event in the futures market. It's also true that COMEX registered inventories can shift quickly as metal gets reclassified between registered and eligible categories, meaning a tightening coverage ratio doesn't automatically translate into an inability to meet delivery demands. There have been previous periods, including stretches in past years, where physical premiums ran hot for weeks or months, and the paper and physical markets eventually reconverged without any major disruption. So it's fair to say that divergence alone isn't proof of an imminent event. It's a signal worth watching, not a guarantee of what happens next. That said, here's a simple mental framework that can help you keep track of this without getting lost in daily price noise. Picture two rooms connected by a narrow doorway. One room is the paper market, enormous, fast-moving, driven by contracts and speculation, where prices can swing based on trading flows that have little to do with physical metal. The other room is the physical market, smaller, slower, but grounded in real scarcity, real vault counts, and real people wanting real ounces. Under normal conditions, those two rooms stay roughly connected. Prices in one reflect prices in the other, because arbitrage traders can theoretically move between them. But when the doorway narrows, when it becomes harder to convert paper claims into actual metal without friction, delay, or added cost, the two rooms can drift apart for a while. Your job as an observer isn't to predict exactly when or how they reconnect, but to notice when the doorway is narrowing, and that coverage ratio we talked about earlier is one of the clearest signs of that narrowing you can track. Let's talk about how this could play out going forward, keeping in mind that nobody can predict markets with certainty, and this is about understanding possibilities rather than making promises. One path is that mine supply gradually catches up, industrial demand growth moderates slightly, and the two markets reconverge smoothly, with premiums easing back down as physical availability improves. That's the calm scenario, and historically it has happened before. Another path is that the gap continues to widen. Refiners struggle to keep pace with retail and industrial orders simultaneously, and at some point, the futures market has to acknowledge the tightness happening in the physical world, potentially through a sharper repricing. A third possibility, and this one gets less attention, is that the two markets simply continue operating with an unusual gap for an extended period, because paper trading volume is so much larger than physical trading volume that it can dominate the headline price for a long time, even while physical tightness persists underneath. None of these paths is guaranteed, and reasonable analysts disagree about which is most likely. So what does any of this actually mean for your day-to-day financial life, beyond being an interesting market story? For one, it's a reminder that headline prices don't always tell the complete picture of what's happening in an asset class, whether that's silver, housing, or anything else you might be tracking. If you already hold any physical silver, understanding premiums helps you make sense of why the price you'd pay to buy or the price you'd receive to sell doesn't always match the spot price quoted on financial news sites exactly. If you're someone who's been considering learning more about precious metals as part of a broader financial education, this divergence is a genuinely useful case study in how different market structures, paper contracts versus physical delivery, can behave differently even when they're technically pricing the same underlying asset. And more broadly, it's a good exercise in reading beneath the surface of any price chart, asking not just what the number says, but what's actually happening in the real world behind that number. To wrap this up, here's the core takeaway. The paper price of silver and the physical availability of silver are right now telling two somewhat different stories. Futures pricing reflects an enormous, fast-moving market of contracts and trading flows, while the physical market reflects real scarcity showing up in premiums, wait times, and vault inventories. The coverage ratio between COMEX registered inventory and open contract obligations is one of the clearest windows into how tight that connection between the two markets has become, and it's worth keeping an eye on going forward, not as a source of fear, but as a tool for understanding what's genuinely happening beneath the headlines. Markets like this don't move in straight lines, and reasonable people can look at the same data and reach different conclusions about what comes next. This video is for informational and educational purposes only, and nothing here should be taken as financial advice or a recommendation to buy or sell any asset. Always do your own research and consider speaking with a qualified financial professional before making investment decisions. Thanks for watching, and I'll see you in the next one.